Something shifted in the housing market in early 2026 that most homeowners haven't noticed yet. And if you're sitting on a mortgage rate somewhere in the threes, this shift directly affects the math you've been running in your head every time you think about moving. So stay with me, because by the end of this video, you're going to know 3 specific strategies that let you keep the financial benefit of your low rate, or at least most of it, while you're still getting into the house you actually want to live in. So quick note, if you're serious about making a move this year, I put together a free guide to buying in 2026. Links in the description. Okay, so here's what changed. For the first time since the pandemic, the share of homeowners with mortgage rates above 6% has now passed the share of homeowners with rates below 3%. That's a big deal. It means this so-called lock-in effect, which was just a fancy way of saying you feel trapped because your rate is so good, it's starting to loosen across the entire market. More people are listing, more inventory is showing up, and here's the part that matters to you. All major forecasters are predicting home prices will continue to rise modestly in 2026, somewhere between 0.5% and 4%, depending upon your market. So every month you sit still, the home you eventually want to buy is likely getting more expensive while you're waiting for something that probably isn't coming. So let me ask you something. What rate are you actually waiting for? Because here's what I see people do, and I say this with zero judgment because it's completely human. You anchor to your current rate. You think, I have a rate in, let's say, the threes. So moving only makes sense if I get back to the threes. But that rate was a product of the global pandemic. It took a once-in-a-generation economic shock to push rates that low. Every major forecast right now, Fannie Mae, the MBA, Freddie Mac, puts rates settling somewhere in the high 5s to low 6s by the end of this year. Nobody credible is calling for a return to 3s or 4s. So the question isn't, will rates come back down to where I am? The question is, what am I giving up while I wait for something that may never happen? And that's where the psychology gets interesting. I had a client last year, family of 5, cramped in a 3-bedroom, rates in the low 3s. They told me flat out, we can't afford to move. But when we actually sat down and ran the numbers, they had over $200,000 in equity. Their home was worth almost double what they paid. The issue wasn't that they couldn't afford to move. The issue was that losing the rate felt like losing something. Psychologists call this loss aversion. Losses feel about twice as painful as the equivalent gains feel good. So even when the math works, the feeling of giving up that 3% rate kind of creates a paralysis. You don't move because it feels like a loss, even when staying is actually costing you the life you want. Okay, so let's fix that. Here are 3 strategies, and the third one, honestly, the most creative. I'll get to it in a minute. Strategy number 1, keep your home, rent it out, and buy a new primary residence. This is the most straightforward way to have it both ways. You can keep your low rate mortgage on your current home. You find a tenant. That rental income covers your existing mortgage payment. You can even use a rental management company to do all of that. Then you go buy your new home with a new mortgage at today's rates. And here's how it works from a qualification standpoint. Most conventional lenders will let you use 75% of your expected rental income to offset your existing mortgage payment. So if your home could rent for, let's say, $2,000 a month, the lender counts $1,500 toward your old mortgage payment, which can dramatically free up your debt to income ratio. That's just the percentage of your monthly income that goes towards debts to qualify for a new loan. What we need to do is pull up comparable rental listings in your area, Zillow, Rentometer, even Craigslist, find 3 to 5 homes similar to yours, and they write down what they're renting for. If the average rent would cover your current mortgage payment, that's your green light. If the rent would only cover 75 or 80%, it could still work, but the math is tighter and you'll want to run it with a lender like me. The one thing to watch, you'll need to switch your homeowner's insurance to a landlord policy, little detail, which is typically a bit more. And check with your mortgage terms. Most conventional and even some FHA loans allow you to convert to a rental after you've lived there for at least 6 months to a year. So here's strategy number 2. And this is where it gets really interesting. So if you've been watching casually, lean in. You can offer seller financing to your current home to a buyer. Instead of selling your home the traditional way, you become the bank. The buyer pays you monthly, just like they'd pay a mortgage company, but the payments come directly to you. And here's where this gets powerful. You get to keep your low rate mortgage in place. Let's say the rate is 3%. You offer financing to your buyer at, let's say, a rate that's competitive in today's market. Think somewhere in the range of 6%, where conventional loans are currently. The difference between what you're paying the bank and what you're buying, that buyer is paying to you. That's your spread. That's your monthly income in your pocket every single month. Now, this isn't for everyone. You need to own the home or have the seller financing structured carefully with a real estate attorney, because most mortgages have something called the due on sale clause, meaning the lender can demand full repayment if ownership transfers. The safest version is when you own the property outright or when you set it up through proper legal structure. You also want a third-party loan servicer handling the payments. That runs around $25 to $30 a month. And you want an attorney, of course, drafting the legal documents and promissory note. This is not a do-it-yourself strategy, but for the right person, it's brilliant. Who is this for? Someone who's built significant equity, ideally owns their home outright or close to it, and wants to create a passive income stream while moving into their next home. Who this is not for? Someone who needs every dollar from the sale for their next down payment, or anyone not comfortable with legal complexity. If you want help figuring out which of these strategies fits your specific situation, download the Guide to Buying in 2026. The link is right below this video. It walks you through the numbers step by step. Okay, so now here we go. Strategy number 3, the bridge and recast combo. This is honestly the one most people don't know exists, and it might be the cleanest move of all. So here's the play. You buy your new home first using a bridge loan or qualifying with both of your mortgages temporarily. You move in and then sell your old home or rent it out. Once that old home sells, you take the proceeds, let's say it's $100,000 or more in equity, and you make a lump sum payment towards your new mortgage. Then you ask your lender, me, to recast your loan. A recast is different from a refinance. With a refinance, you get a whole new loan, new rate, new terms, and you pay closing costs all over again. With a recast, you keep your same loan, same rate, same terms, but the lender recalculates your monthly payment based on your new lower payment, lower balance. So your payment drops significantly, but your rate stays exactly the same. The fee for a recast is usually a couple of $100. Compare that to the thousands you'd spend on a refinance. Here's the catch. Not every lender offers recasting, and government-backed loans like FHA and VA typically cannot be recast, but most conventional loans you can. So when you're shopping for your new mortgage, ask this specific question. Do you offer mortgages recasting? If the answer is no, keep shopping. Here's your 3-step action plan. Step 1, go to Zillow or Rentometer right now to look up what your current home could rent for. Write that number down. If it covers your mortgage, the rent it out strategy is on the table. Step 2, check your equity. Pull up your latest mortgage statement. Your remaining balance is right there. Then look up your home's estimated value in Zillow or Redfin. Now, they're not always right, but they're close. Subtract the balance from your value. That number is your equity, and it tells you which strategies are realistic. If that's a strong number, seller finance or the bridge and recast combo could work. Then step 3, call a lender, me, or any lender, but call me, and ask 2 questions. 1, can I qualify carrying 2 mortgages if I have a signed lease on my current home? And 2, Do you offer mortgage recasting? These two answers will tell you which strategy fits your situation. You don't need to figure out all of this alone. That's literally what I do. If this helped you see your situation differently, do two things. Download the guide to buying in 2026 using the link in the description. And if you would, hit subscribe so you don't miss what's coming next.